So we saw the CPI data in Canada is trending downwards. We saw the GDP came out pretty much flat as well, but we saw last Friday Stats Canada published their job numbers, and unexpectedly or expectedly, that has blown up the overall forecasting and estimates that the mainstream economists and even the Stats Canada themselves were forecasting. So according to the mainstream media, the jobs number that was published was around 60,000, but then the economists, including the Stats Canada, were expecting 20,000. So it's three times more than what they were expecting. So there could be only one explanation to that. Number one, either the Stats Canada and their economists and mathematicians and statisticians are either incompetent, they could not even forecast accurately, or the economy is really on fire. I'll let you be the judge. But let me share the screen so we can talk through it. So basically, what we're going to talk about is, the possibility of the rate hike decision. It's going to happen on July 12th, which I've been talking about in my videos, that this is pretty much is going to happen, and these job numbers have further solidified the case where Bank of Canada has to increase the interest rate at least 25 basis point on July 12th. But the key thing here I want to discuss with you is, would like to understand what's going to happen next after that. What is going to be the event that will trigger further economic deterioration in this country? So let me just share this screen. So according to BNN Bloomberg, they are saying that where the job numbers really surprised, right? So we had 60,000 jobs published last month compared to what was expected, which is 20,000 jobs. So either they're utterly incompetent or the economy is still on fire. You can decide what's really the truth. In my opinion, the economy is really struggling. I think the people who are forecasting and estimating these numbers, they have lost the plot. That is really one of the excuses that Bank of Canada will look at it to see, okay, the economy is still hot. The job numbers are still very much strong, which make sense for them to increase the rate by 25 basis points again. But one economist also is talking about the same thing that I have been telling you guys, that these rate hikes takes months and sometimes years before they actually roll over in the economy. So according to this economist, he's also saying the same thing. He's saying the economy might be already slowing down. Like, these rate hikes are already perhaps having an impact in terms of the consumer spending. But I think we are focusing on wrong things. What we are focusing on is the growth. And that growth could be a natural phenomena after the 2 years of lockdown, where people have not even performed the typical economic activity in terms of spending money in travel and tourism and restaurants. And then we saw an uptick right after that. That could be a natural phenomenon. So that's his argument. But my argument is, if you look at the demographics in the economy, and this is just my observation, I have no data to back it up, that the young generation, they really don't have the liabilities that the boomers have in terms of the mortgage payments, in terms of the car payments. Like, if you talk to a young person who is still in the college, or they have left the college, they don't have a desire to own a car. They don't have a desire to perhaps own a house or condo and take the liability of the mortgage. So when you look at that segment of the demographic, their purchasing power is not pretty much impacted as a result of interest rate hikes. It's the other segment in the demographics, which is the boomers, who have the mortgage payments, who have the car payments, the credit cards, and they are really feeling the pain of the rising interest rate, not the other segment in the economy, which explains, why we are still seeing the restaurants are full up with people. The tourism is still running very hot. People are still flying and going on vacations. But if you look at the demographics, it's more of the people are in the young age who do not have those liabilities that the other segment of the demographics have. So that could explain why we're still seeing the restaurants are full, the planes are full, people are still spending money. In reality, the rates are basically having impact. And one of the reasons why we can see that the economy is still struggling is the PPI. I talked about that CPI is a lagging indicator, PPI is a leading indicator that shows the PPI is really collapsing in the last 3 months, collapsing, right? That will be reflected in the CPI in the next coming months. It hasn't been shown in the CPI yet, but this is coming. So that shows the economy is really struggling. It's not on fire, it's struggling. And the sensitive sectors in the economy, like real estate, is already feeling the pain. As I mentioned, that the real estate market is slowing down. And after July 12th rate hike, it will further deflate the overall real estate bubble. But I think there is no one single real estate market. The real estate market is comprised of many real estate markets across the country. And one of the example is Calgary. So we're seeing that the Calgary market is still on fire. And the main reason is a lot of people moving from other provinces like Ontario and BC to Calgary because that city is still affordable. I've known people, some of my friends have taken the decision to leave Ontario and then settle in Calgary because of affordability in terms of lifestyle. So that's happening as well. And if we also look at how these things will shape up, if we see another rate hike, which will likely happen on July 12th, which means the real estate market will further slow down and the demand will be absolutely killed after that, because it's the sentiment that is going to be impacted right away. And we have seen the summer market is already kicking in. It's traditionally a slower time in terms of market activity, but these rate hikes decisions will further kill that. We'll see a quiet summer from a buying and selling perspective. Perhaps it can pick up in the fall market, who knows? The data will determine. But right now at these rates, the affordability is really a big challenge for anybody. Even if you own a property, if you want to sell it and you want to take or upgrade or downgrade, it's not easy to sell in this market right now, especially if you are owning a over $1 million property in GTA. I have also taken a step in terms of downsizing. So I sold my property in GTA, moving out of GTA and trying to reduce my mortgage liability, because I believe this is the best thing I can do right now. I don't want to carry a $600,000 mortgage at 6.5% interest rate for the rest of my life. I know that the rate may not stay at that level. It may come down next year or year after, but who knows? This is all speculation. If the rates at least stay at that level, at this level, I'm not willing to pay my entire life against my primary residence. So I have decided to downgrade or move out of GTA just to reduce my mortgage liabilities. I think everybody should do that. If you are overly leveraged, you should consider how you can deleverage yourself. There could be many other ways to do that, but this is what I thought, because my work style is very much remote working, so I can't really afford to live outside GTA. But you can decide for yourself which one works for you best. If you like this video, give me a thumbs up, share and subscribe, and I'll see you in my next video. Thank you.